If you've ever looked at small business acquisitions and thought, why do so many good companies struggle to find a buyer? Today's episode is for you. We're talking about the lower middle market, that huge band of small and mid-sized businesses where deals should happen all the time, and yet so many don't. Not because the businesses are bad, but because the market is missing something essential, enough qualified buyers who can both pay for the company and actually run it.
And that both part is the whole story. It's not just capital. It's leadership capacity, operational skill, and the ability to take over without breaking what already works. In this space, you can have a business with solid customers, strong cash flow, a good team, and still watch a transaction fall apart because the fit isn't there.
Right. And when fit is missing, two ugly things usually happen. One, valuations get pushed down. A lack of capable buyers means sellers don't get paid what the business is truly worth. And two, deals fail to close outright. You can get all the way to this is happening, and then the buyer, the financing, or the transition plan just can't support reality.
So let's frame the mission here. The goal isn't to do deals. The goal is to help great SMBs transition ownership successfully in a way that's good for the seller, the buyer, and everybody who depends on that business: employees, customers, vendors, local communities. The opportunity is huge because when you fix this buyer deficit, you unlock value that's been stuck for years.
Let's unpack what makes SMB M&A so tricky. People hear M&A and imagine a simple handshake. Buyer meets seller, price is agreed, papers get signed. But in the lower middle market, it's more like a living ecosystem. A single deal can involve an acquirer, a seller, equity partners, lenders, attorneys, tax folks, accountants, and a team running the process. If even one piece is late, unclear, or misaligned, the entire thing gets wobbly.
And the word we keep coming back to is fit. Financial fit, operational fit, timeline fit, personality fit. If the seller wants a clean exit in 60 days but the buyer needs 6 months to line up financing and build a transition team, that's not fit. If a buyer wants to roll up 3 companies in a year but the target business needs hands-on leadership every day, that's not fit either.
So the approach we're exploring today is a deliberately structured, holistic process. Not spray and pray. Not, let's list it and see what happens. It starts with understanding people first, then aligning incentives, then building the capital stack and diligence plan in parallel, and finally supporting integration after the ink dries.
Let's walk through a clean 3-phase model. Phase 1. Understand the acquirer, the sponsor, the person or group who wants to buy and lead the business. This is deeper than how much money do you have. It's, what are you actually trying to accomplish? Are you buying for stable cash flow? Do you want to expand into a new geography? Is this vertical integration? Or is it a search for a single great company to operate for the next decade?
And you also have to map capability honestly. What skills do they bring? Sales? Operations? Finance? Industry knowledge? And just as important, how much bandwidth do they really have? Because plenty of buyers might be smart and motivated, but if they don't have the time or the management depth, the business can suffer immediately after closing.
Then there's the practical side. Deal criteria and timeline. What size business are they targeting? What margins? What complexity level? How fast must this happen? When you do this well, you're not just qualifying a buyer. You're building a picture of the kind of company they can realistically buy and grow.
Phase 2. Identify and align the seller. And again, it's not just, do they want to sell? It's, why are they selling? Retirement? Burnout? No successor? Wanting to de-risk? Needing capital? A seller's motivation shapes everything. Structure, timeline, willingness to carry a note, and how involved they'll be after close.
And this is where a lot of deals get quietly sabotaged: valuation confusion. If valuation starts off fuzzy, unrealistic, or overly optimistic, you may still get momentum early, but it comes back to bite you later. You end up in late-stage arguments. The buyer feels misled, the seller feels disrespected, and the advisors start circling with gotcha issues.
So a big pillar here is a valuation that's transparent and grounded. Not magical thinking, not my friend sold his company for 10 times EBITDA, but a realistic view of the business. Risk, durability of cash flow, customer concentration, management depth, and growth drivers. When everyone starts from reality, you reduce drama later.
Now phase 3 is where this becomes truly strategic. You run integration planning and due diligence alongside financing and structuring, instead of doing everything in a strict line. This is where more parties are brought in: equity providers, debt providers, legal and tax advisors, and the tooling that keeps the process clean.
Let's name those roles clearly, because it helps people understand how many moving parts actually exist. You got the acquirer or deal sponsor. You got equity solution providers who can support the purchase with different equity structures. You got debt providers, banks, non-bank lenders, SBA options depending on the deal, who set covenants and terms that can make the difference between an easy first year and a nightmare.
You've got the seller, obviously, who has their own goals and anxieties. Then trusted advisors, attorneys handling structure and legal diligence, tax advisors optimizing the outcome and reducing nasty surprises, and accounting professionals who validate the numbers. And finally, you've got a solution team that plays air traffic control, keeping the process moving, managing information, supporting valuation work, and helping prepare for day one operations after close.
Here's a question I like to ask. What do deals fail on most often, price or uncertainty? And in my experience, it's uncertainty. When the buyer can't get comfortable with the financials, when the lender can't get comfortable with cash flow, when the seller can't get comfortable with the transition plan, people freeze.
Exactly. So the holistic process idea is really an uncertainty reduction machine. It's a system that creates clarity. Clarity on expectations, clarity on timeline, clarity on who is responsible for what, and clarity on whether this is truly a fit before everybody burns months of time.
Let's also define the sandbox. We're talking SMBs, but with a specific scope, roughly 1 million to 100 million in annual revenue. That's a wide range, but it shares a common reality. These companies are big enough to matter, and small enough that leadership and execution are everything.
And that's why the buyer quality gap hits so hard here. At the very top end, you've got institutional capital and professionalized operators. At the very small end, you might have simpler deals, sometimes messy, but less complex. In the lower middle market, you're in that zone where the company is meaningful, but the buyer has to be both financially credible and operationally competent.
Now let's talk operating philosophy, because process without mindset doesn't hold. The philosophy here is a mix of determination and humility. Determination to drive toward a good outcome, and humility to listen when the deal reveals something new. Because every business has its own story, and every transaction surfaces surprises.
I love that combination because it prevents two common failures. One is being so aggressive that you steamroll people and create resistance. The other is being so passive that the process drifts until the deal dies of old age. You need forward motion, but you also need ears.
Let's get practical about tools and partnerships. In a high-stakes deal, organization is not a nice-to-have. It's survival. A strong M&A platform can keep documents, workflows, valuation logic, and diligence requests from turning into wild email chains.
One example of that kind of backbone is a process and valuation platform like Iconic, something that helps you run the workflow, manage data rooms, keep tasks visible, and maintain a valuation narrative everyone can follow. And capital partnerships matter too. A group like Phoenix Capital Solutions, for instance, can provide flexible ways to think about equity, which often becomes the key to making the financial fit work.
Because capital structure isn't just a spreadsheet. It shapes the buyer's ability to invest after closing. It shapes the risk the seller is taking, and it shapes the lender's confidence. A weak structure can strangle a business right when it needs oxygen for growth.
Now, here's the part a lot of M&A conversations skip. What happens after the closing dinner? Some people treat closing like the finish line. But in reality, the close is the starting gun. The biggest risks, and often the biggest value creation opportunities, show up in the first 30, 60, 90 days.
So a real differentiator is staying involved post-close, not to micromanage, but to support integration, to be that calm sounding board when a new owner hits their first, "Oh, wow, this is real" moment, to help think through cash flow improvements quickly, and honestly, to be the people in the corner saying, "You're doing the right things. keep going.
And if you want an honest definition of success, it's not "we got the deal done." It's "the business is stable, the team stayed, customers didn't panic, cash flow is improving, and the new owner has momentum." That's the point.
So if you're listening as a potential buyer, here's a reflective question. Are you preparing to own a business, or are you just preparing to buy one? Those are different skills. Ownership requires operating rhythm, leadership, and a plan for day one.
And if you're listening as a seller, here's yours. What does a good exit actually mean to you? Maximum price. Clean break. Keeping the legacy intact. Protecting employees. Your answer should shape the buyer you choose, not just the multiple you negotiate.
When you put all of this together, the mission becomes clear. Bridge the gap between good businesses and capable owners. Raise the number of qualified buyers by matching operational talent with appropriate capital. Reduce failed deals by creating clarity early. And support the company after close. So the transition isn't just successful on paper, but successful in real life.
If you want to continue the conversation and talk through an SMB acquisition, capital fit, valuation, or a transition plan, you can reach out by email at michaelschumacher8216@gmail.com.
That's it for today. If this episode sparked questions about buyer readiness, seller fit, or why your last deal got stuck, keep those questions. They're usually the doorway to a better process and a better outcome.